Dick's Sporting Goods isn't just reporting earnings. They're not just moving boxes and selling sneakers. No, they are drawing up the blueprints for a massive global retail empire. But listen, every single blueprint has a stress point. And our job is to find it. This is Iron Financial, where we forge stronger portfolios by putting the market's biggest, boldest designs right under the microscope.
An empire? That's a strong word. I see the blueprint. But are they building an empire, or are they just constructing a billion-dollar skyscraper on a foundation of sand? That's the real question we need to answer today. So, we're not just going to read you the highlights from their press release. Oh no. We are taking the company's incredibly ambitious plan, laying it out on the table, and we are going to stress test every single girder, every weld, and every rivet to see if this structure can actually handle the immense weight they're about to put on it. Let's get to work.
Okay, here's our inspection plan for the day. Think of it as our architectural review. First, we start by looking at the sheer scale of this thing. Are they really trying to forge a new retail giant? Then, we're popping the hood to look at the core engine, what I'm calling DKS Prime, the business that has to power this entire operation. After that, we'll review their official blueprint for growth, before the skeptic here takes out his magnifying glass and starts looking for cracks in the foundation. We'll finish with the main event, a brutal stress test of their shocking new guidance, and then we'll deliver our final verdict. Is this a generational opportunity, or is this a carefully constructed trap for investors?
And here we go, straight from the top. This statement from CEO Lauren Hobart, look, this is more than just a nice quote for a press release. This is the official groundbreaking ceremony. When a CEO says something this definitive, it's a line in the sand. They are putting their reputation, their legacy, and billions of dollars in shareholder capital on this one single premise. Stronger together, that's the vision they've pitched to the market. So our job today is to verify the engineering behind that very confident promise.
All right, let's get right to it. Section 1. Forging a retail giant. Before we get into the weeds of the financials, it is absolutely crucial that you understand the sheer scale of what they are attempting to build here. I want to be clear, this is not a minor renovation project. This is a ground-up reconstruction of their entire place in the market. This is a massive, ambitious move to escape the gravity of being just a North American retailer, and to finally enter the global arena as a true heavyweight.
It all starts with the price tag, $2.5 billion. Let's be absolutely crystal clear about what this number represents. This is the total consideration for the Foot Locker acquisition. This is a company-defining, bet-the-farm kind of move. You do not commit this level of capital for small, incremental gains. You do it because you believe you are fundamentally reshaping not just your company, but the entire industry for the next decade and beyond. This is the entry fee to become a global titan, and they paid it in cash.
Whoa, hold on a second. Let's be very precise about what that $2.5 billion actually bought them. Because when I look at this slide, I don't just see a list of assets. I see a list of very expensive problems. You're not just buying the iconic Foot Locker brand, you're inheriting Kids Foot Locker. You're getting Champ Sports, which has been fighting for its life with that mall-based footprint for years now. You're taking on WSS and Atmos, two other distinct banners with their own supply chains, their own inventory, their own customer bases. You're not just adding a nice new wing to your well-built house here. You're buying 5 different properties scattered all over the world, some of them in serious disrepair, and promising the market you can manage them all while your own house is also undergoing a massive expansion. The operational complexity here is, well, it's just staggering.
And that's a completely fair point about the complexity. It's huge. But any good engineer, any good architect will tell you the same thing. Before you can even think about building a massive superstructure, you need bedrock. You need a powerful, stable foundation that can support the immense weight of your ambition. And that is exactly what the entire bull case rests on, the core Dick's Sporting Goods business. Let's call it DKS Prime. This isn't just a part of the company, it is the engine room. It's the power plant for the entire enterprise. So let's see just how powerful that engine really is.
Okay, first piece of evidence for the bulls, 4.5%. That is the full year 2025 comparable sales growth for the core Dick's business. Now, in a retail environment where most of their competitors are fighting tooth and nail just to stay flat, 4.5% is a statement. It's a statement of raw power. It tells you unequivocally that their core strategy is working. Customers are walking into their stores, they're opening their wallets, they're spending more money than they did last year, and the business is firing on all cylinders. This is the fundamental strength you absolutely must have to even consider funding a project of this magnitude.
And just look at the efficiency of that engine, 30.55% return on equity. This is such a critical number and it gets overlooked. It is not just some boring accounting term, it tells you exactly how effectively management is using shareholder capital to generate profits. For every single dollar of equity that you, the shareholder, have in this company, they are generating nearly 31 cents in net income. Over 30%? That's not just good, that's elite territory. That is the sign of a profitable, well-oiled machine that just throws off an enormous amount of cash. This isn't just a big engine, it's a high-performance one. This is the financial firepower that gives management the confidence, maybe the audacity, to take on a project as massive as Foot Locker.
And this level of performance isn't a one-time fluke, it's consistent. You just have to look at the most recent quarter. They didn't just meet Wall Street's expectations, they shattered them. They beat on earnings per share, and they delivered a really significant beat on revenue. They told the market they'd hit one number, and they came in much, much higher. This isn't a company that's just hoping things go right. This is a company that is executing with surgical precision quarter after quarter. This shows incredible operational momentum right as they head into the biggest challenge in their entire corporate history. The bulls are pointing to this foundation, and you know what? It looks like it's made of solid granite.
So, with that rock-solid foundation now established, we can finally look at the official blueprint. How exactly are they planning to build on top of that strength? This is important. The plan isn't just about trying to fix the newly acquired and, let's face it, struggling Foot Locker business. No, it's about simultaneously and aggressively expanding their own proven winner, the core Dick's store concepts that are already delivering those stellar results we just looked at.
The key takeaway from this table is the sheer, unadulterated pace of this expansion. They opened 16 of their new and highly successful House of Sport locations in 2025 and plan to open another 14. And remember, these aren't just stores. They're experiential destinations with climbing walls and batting cages that people want to go to. For their smaller fieldhouse concept, they opened 15 and are planning to nearly double that with another 22. This is management seeing a winning formula that drives traffic and high-margin sales, and they are putting the pedal to the absolute metal. They are not waiting, they are not being tentative. They are using the cash geyser from their core business to aggressively roll out the future of their retail footprint because they know it works.
And this right here, this single table, is the entire bull thesis in a nutshell. Just look at the two sides of this story. On the left, you've got the DKS prime business, solid 2 to 4% comp growth with a powerful double-digit profit margin of 11 to 11.2%. That's the fortress, that's the engine. On the right, you have the Foot Locker business they just bought, slower growth and a razor-thin, almost negligible profit margin of 1.3 to 1.9%. The bull argument is simple and powerful. The DKS engine is so strong and so profitable that it can easily carry the weight of the low-margin Foot Locker business while they perform a multi-year, very complex turnaround. They believe they can afford to fix Foot Locker because their core business is an absolute cash-generating machine. Okay, that's a very nice story. It really is. The blueprints look fantastic. The artist renderings are beautiful, I'm sure. But you know, anyone who's ever run a major construction project knows that the plans are one thing, and the cold, hard reality on the ground is something else entirely. So now it's time to put on our hard hats, walk the sites, and check for the real-world costs and the potential for catastrophic structural weaknesses. It's time to find the cracks in this foundation.
So let's frame this entire bear case with one simple but crucial question. We've heard the bull's very compelling case on potential and opportunity. Now we need to switch gears and focus exclusively on risk. What are they truly taking on with this massive project? What are the costs that aren't featured in that glossy Investor Day presentation? What are the hidden liabilities buried deep in the footnotes of their financial reports?
And here is the first one, and it is an absolute monster. $500 to $750 million. Let me just repeat that so it sinks in. Up to $750 million. And that's not my number, that's the company's own estimate for pre-tax charges just related to the integration. This isn't profit, this isn't revenue. This is the immediate, painful, cash-out-the-door costs of this grand vision. This is money for severance packages, for breaking leases on unprofitable stores, for writing off tons of old inventory, and for trying to merge incredibly complex IT systems. So before they make a single extra dollar of profit from Foot Locker, they have to stomach a hit of up to $750 million. That is a massive hole to dig yourself out of from day one.
And please, don't just take my word for how messy this project is. This is management's own phrasing. From their own conference call, they described part of the integration process as clean out of the garage efforts. I mean, just think about what that phrasing implies. It paints a picture of a business they acquired that's not just underperforming, but is cluttered, disorganized, and just full of unproductive, dusty assets.
This is not a turnkey operation they bought. This is a distressed fixer-upper that requires a massive, expensive, and incredibly time-consuming cleanup before any of the real value-added renovation can even begin. And this right here is the number that should keep every single bull up at night, 0.37. That is their quick ratio. This is a critical liquidity metric, and it's one of the first things any serious analyst looks at. It measures a company's ability to cover its short-term liabilities, all the bills due within a year, with its most liquid assets, like cash. Now, a ratio under 1.0 is considered a warning sign. A ratio of 0.37 is a major, flashing red flag. It means for every dollar they owe in the short term, they only have 37 cents in ready cash to cover it. This gives them absolutely no margin for error. If those integration costs balloon past $750 million, if core sales suddenly slow down, if anything unexpected goes wrong, they could face a very serious cash crunch. This, to me, is the biggest crack in the entire foundation. Plain and simple.
All right, I'll concede that liquidity number is a serious point, and it cannot be ignored. But let's bring this entire debate right to the centerpiece of the whole report, the company's blockbuster 2026 guidance. This is where the bull and bear cases have their final, brutal showdown. Because let's be honest, management has laid down a number that absolutely no one on Wall Street saw coming.
Just look at the scale of their confidence here. The market, the entire collection of the smartest analysts on Wall Street covering this stock, was expecting revenue of around $19 billion. Management came out and guided for $22.1 to $22.4 billion. That's over $3 billion higher than the consensus, and that's just at the low end of their own range. This is not a small beat to manage expectations. This is a mic drop. This is management looking the entire market in the eye and telling them, you don't understand our business. They see a fundamental step change in the earning power of this combined company, and they are not afraid to put their credibility squarely on the line with this forecast.
Okay, the number is huge. You've got me there. It's a big, shiny number. But big numbers can hide some very big problems. So let's push back hard on this. First, is this guidance realistic, or is it merely aspirational? Is it a big, juicy carrot they're dangling to keep the market happy while they go through a painful, multi-year integration? Second, and this is the most critical question of all, how much of that massive $3 billion revenue beat is just low-margin, barely profitable Foot Locker sales? Let's not forget the old saying, revenue is vanity, profit is sanity. Is this huge top-line number just masking a much weaker, diluted bottom line? Can they really pull off a messy global integration while also trying to hit these aggressive organic growth numbers at home? And finally, does that pathetic 1.3 to 1.9% profit margin from the entire Foot Locker business justify all the risk, all the debt, and that terrifying 0.37 quick ratio? I am just not convinced it does.
All right, we have laid out the blueprint, we've analyzed the foundation, and the skeptic has found some very real, very significant cracks. So it is time for the final verdict. Let's put all the pieces together and give you a clear takeaway for your portfolio. Is this an opportunity to buy into the construction of a new retail fortress, or is it a very cleverly disguised financial trap?
So here's the bull case, boiled down to its essence. You are investing in a proven, well-managed company with a rock-solid foundation. The core DKS business is a fortress with incredible profitability demonstrated by that 30% return on equity and consistent market-beating sales growth. They have a winning strategy with their new House of Sport concepts that they are aggressively and successfully expanding across the country. They have put forth guidance so confident that it shocked the entirety of Wall Street. And now, they are using their position of immense strength to make a bold, strategic acquisition to transform themselves from a national champion into a global titan. The bull case is that this is how great empires are built, on a foundation of strength with a bold vision for the future.
But the bear case sees a potential house of cards. The core foundation might be strong, sure, but the superstructure they're trying to build on top of it is incredibly risky and completely untested. You have the massive, guaranteed cash cost of integration, up to $750 million, just gone. Before you even start, you're bolting on a low-margin business that will immediately dilute the company's overall profitability. The weak liquidity position, that 0.37 quick ratio, means the entire structure is brittle. There is no financial shock absorption if the economy turns or the integration hits an unexpected snag. And the execution risk is simply off the charts. Can this management team really truly turn around a struggling global brand like Foot Locker while simultaneously executing a capital-intensive expansion of their core business? It seems like one misstep, just one, and the whole thing could become dangerously unstable.
So there you have it. The blueprints are on the table. Dick's Sporting Goods is, without a doubt, building something massive, something that will define the company for the next generation. The question for you, the investor, is to decide what you're really buying into. Are you buying the cornerstone of a new retail empire, a solid piece of a future fortress, or are you buying into a project whose ambition has far outstretched its structural integrity, a magnificent but ultimately fragile house of cards? That is the multi-billion-dollar question you have to answer for your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.